Welcome back, everyone. Tony Cousins gave us a really good overview of markets and what he's seeing globally. And next up, I'm very pleased to welcome David Roberts. He's the head of Palomar Fixed Income and a portfolio manager of the Nedgroup Investments Global Strategic Bond Fund. David, welcome back. So nice to see you.
You too, Anil. Good to be here.
Yeah, thank you so much. I mean, surviving these markets must be quite a challenge and quite an achievement.
Yeah, well, I've been through a few crises over the last 3 decades, and I know it looks really difficult at the moment, but in all honesty, I have seen worse, and we can see where we go from here. But it's a good opportunity for active managers. We just need to try and stay calm and focus on making some positive returns for our clients.
The value of experience, eh? So David, if we could please start by discussing performance of the fund. I mean, last I checked, the fund was doing very, very well. And if you can please also just chat through some of the context around markets that you're observing.
Yeah, sure, no problem, Anil. Yeah, the first quarter was very pleasant for us, and obviously by extension for our clients. We outperformed the market and posted a positive total return. And we sometimes get too hung up on relative returns, but we know pretty much everyone wants to see a positive number. The reason for it's quite straightforward. Really, since Trump was elected, what we've seen is increased volatility and worries in the global system about change, uncertainty, and the possibility of a global recession led by the US. So that's helped US Treasuries, but also other G7 bonds post positive total returns. The most pleasing thing I would say, Anil, from our perspective, is that January and February were constructive for bonds. So prices went up and we outperformed the global index in each occasion, so in a rising market. March was more tricky, and although prices fell in the market, we continued to outperform even in that discrete month. And that's quite difficult normally for an active manager without any major strategy change. And as we'll see maybe in a minute or two, we didn't change our strategy. It was really about just looking for those small opportunities in times of uncertainty to add some value.
And David, I mean, maybe just if you can just for a moment, before we get into Trump and the tariffs and all the volatility and noise around that, but maybe just talking through just some of the details as to how you achieved that outperformance, please.
Yeah, I mean, in terms of the drivers behind those excess returns, I think the first thing we need to remember as bond investors is that income is very important. And a significant proportion of our total return, whether it's domestic investors in South Africa and international investors, a significant proportion is driven by income. Attributing beyond that, especially when markets are highly volatile, can be difficult. We do have systems to guide us, but really there's an element of, I wouldn't say guesswork. We know where we're performing, we understand our risks, but sometimes the nuance of asset allocation to performance can be tricky. Probably the three main things for us though over the quarter were firstly asset allocation. We had a positive weighting to corporate bonds, particularly high quality investment grade. And through March, because prices became quite stretched, we sold quite a large proportion of those, about 15% of the fund actually. That was a positive during January and February. And then, as I say, that rotation, that reduction in risk during March has stood us in good stead since. A second thing, which is a little bit fixed income specific, is we talk about interest rate curve. And what we really mean there is that we owned a lot of short-dated bonds. Those generally did well, whereas bonds of a longer maturity, even in a rising market, actually struggled. So that exposure to the short part of the market was good. And then the last thing was we continued with our theme of overweight, what I call developed Western markets versus East, and that's primarily Japan. So Japan has been at a different point in the economic cycle. We expect interest rates to rise in Japan, whereas most other major economies, South Africa included, we expect interest rates to come down. So that combination, asset allocation, curve, and geography, was pretty positive over the course of the quarter.
Yeah, it's quite interesting, eh? And I mean, Dave, just what are some of the other interesting anomalies that you are seeing in markets at the moment, please?
Yeah, there's a few. I put a chart together which talks about the divergence in markets. Now, we're used to, I think, most people consider developed markets, G7, G10, even G20, as generally moving in the same direction, particularly when it comes to bonds. And the chart that I've shown here looks at the difference in the yield between German bonds and US bonds over the quarter. Now, what we saw was, as I say, worries about Trump and tariffs. The impact in US bonds was to bring yields lower, to push prices higher as people feared recession and wanted that stock of value that fixed income provides. Whereas in Germany, what we heard was a need to spend more money to fund defence. And that expectation of higher bond issuance, more supply, combined with worries about how exactly it would impact on German fiscal deficit, so German bonds fall in price. So it doesn't sound as if that's really too much, but when you consider it in percentage terms, German bonds underperformed American ones by something like 7%. Now, these are like two huge economies that normally move in lockstep. So see that influence of Trump, of the requirement of different parts of the globe to think in different ways, has created significant divergence, and I say for us, created an opportunity, I think, Anil, to hopefully add some value.
Yeah, wow. I mean, Dave, just kind of related to that point, what about the predictive power of bond markets? I mean, some investors absolutely swear and live and die by it, but potentially can be quite deceptive.
Well, we're asked this a lot, and I think perhaps the best illustration of this is to use US 10-year bond futures. Now, this is, literally a multi-trillion-dollar investment class. It's this part of the interest rate market. And normally when yields rise, that's a sign that things are good, that central banks might have to raise rates, that, maybe some of the riskier asset classes are performing strongly. But the chart I've shown here just really goes back over the last couple of years, and you can see the huge swings, the rise in yields, the fall, the rise, the fall, the rise, and then the fall again. So what that's basically saying is that the bond market over maybe 1 or 2 years has changed its mind about global economies, specifically the US, but how that then impacts the rest of the world, maybe 5 or 6 times. So this idea that we can take what bonds are saying today and use it to perhaps asset allocate to everything from equity through property to even Bitcoin, I think we need to take that with a large pinch of salt, because the bond market has been flipping and flopping backwards and forwards with great regularity, Anil.
And David, I guess the other interesting kind of sub-segment of the bond market is high yield, right? Which investors often love talking about. It's such an exciting place to invest until it's not an exciting place to invest. And especially because they focus on the upside potential, right? Not the downside risk.
Yeah, and again, high yield is an income class, an asset class that lives off income, but sometimes the capital volatility can wipe out that level of income. And we are quite careful in our portfolio. We limit the amount of high yield. We restrict the qualities. We only buy the higher quality parts of the market. And people often ask us why, Neil. And I think this chart that I'm showing, which is the comparison of high yield versus the NASDAQ. So this is not even just core equity. This is high growth, cutting edge equity. Some would say the global leaders wrapped up in one index in the US. And you don't need to be any form of expert or statistician. Just look at the correlation between those two series. As the NASDAQ has collapsed, so too prices in the high yield market have fallen significantly, 4 or 5%. So again, at a time when bonds have been posting positive returns, some parts of the market, and high yield's a valid asset class, but some parts of the market potentially give you returns that are correlated to equity, when in reality what you possibly wanted was some defensive characteristics, especially in times of uncertainty, Anil.
No, I think that's so true. Hey, thank you. And I guess just bringing all of this together then, what does it mean for your forward-looking view of markets?
It's difficult. When we're talking in April 2025, 3 months after Trump was sworn in as president, and I think most of us, irrespective of which jurisdiction we're in, still struggle to work out exactly what US policy is. And I think increasingly what that's doing is pushing many of us to either at a micro level, so what I'm doing in portfolios, or at sovereign level, to seek new ways of doing things and new partners. So our objective is always to try to provide a degree of stability and consistent returns for investors. The difficulties, obviously, at the moment are that economies were slowing before Trump came in across the globe, really, and that trade wars are creating heightened uncertainty. What we worry about is that we will see this global recession led by the US, and that's because the uncertainty creates two issues. It slows investment, so companies are reluctant to invest. I mean, if you think of Apple, for example, multi-$100 billion worth of investment in China and Vietnam, and they're still none the wiser as to whether they have to effectively write those off and bring their production back to the US. Trump is facing midterm elections in little more than 18 months' time. So again, if the Republicans do badly, perhaps there's a change of plan again. So very, very difficult. Central banks, or rather markets, are pricing in significant levels of interest rate cuts, but bond valuations largely reflect that. So we do think that for the foreseeable future, next 3-4 months, the best thing to do is stay, we would describe it as close to home. Don't take any large positions, and really do what we were doing in that first quarter, Anil, which is looking for many small opportunities to diversify risk, to spread risk, so that if we do get something wrong, then we can hopefully offset it by gains elsewhere. So not a time to be a hero, we would say, but rather just to remember you're being paid by your clients, and certainly in our portfolio, we are not being paid to take excess risk, Anil.
Yeah, I think that makes so much sense. Thank you. And then, David, I guess just the last question I had for you for this morning is just about positioning of the portfolio itself. I mean, particularly in these volatile markets, I mean, fund management tends to be quite tricky as it is, let alone in times like this.
Well, that's true. So normally our process is heavily value driven. So what we try to do is assess whether there is good value risk adjusted at any point in time for our clients. And we would say that where most of the bonds that we buy currently are, there is good long-term value. The problem is clearly the potential for volatility in the short term. So two things perhaps just to focus on are firstly is our overall credit risk, and that is actually quite low. As I mentioned earlier, we've taken out certainly between 10 and 15% of the portfolio and put it into safer assets. But what we've also done is improve the quality of what we have left and reduce the amount of interest rate risk. So it's more defensive than we have been for some time. Then the second thing is specifically within that. Now, we would normally talk about having an investment grade weight between sort of 20 and 60% in the portfolio. We brought that down to just over 40 today, so slightly lower than the numbers that we show in the chart. So that's pretty much right in the middle of our range. And again, we're very, very much skewed towards higher quality, selling down a lot of triple Bs. But I think the real thing perhaps comes through in high yield, where we talk about having a weighting of 20 to 30%. We had taken that weighting down well below 20%. We started to add a little bit back, given the improvement in value in the market. So overall, Anil, what we're seeing again is quite a conservative portfolio, certainly more so than we would expect to be through the course of the cycle. What we expect is heightened levels of volatility, and that should give us an opportunity to increase those corporate bond elements, the investment grade, the high yield element, as we go through the remainder of 2025. So I don't think too much to be scared about. It's certainly more of an opportunity, we think, than a threat at this point in time. But importantly, that's because anyone fortunate enough to be in the fund at the moment is enjoying a high level of income, which hopefully will be able to offset the majority of capital volatility, Anil.
Thanks very much, David. Certainly very comforting to hear you say those words, and always love having you. So thank you so much for your time, and we will chat soon.
Thank you, Anil. It's a pleasure.
Okay, best wishes. Bye.